The years leading up to 1929 were defined by a simple, dangerous promise. It was the whisper of wealth amplified by leverage. The mechanism was known as buying on margin. It allowed an investor to purchase $10,000 of corporate stock using only $1,000 of their own cash. The broker provided the remaining 90% secured by the purchased shares themselves. This was not investing. It was pure speculation built entirely on borrowed time. The factory worker, the store clerk, the barber, anyone with a small savings account could suddenly control a substantial portfolio. They were not buying companies. They were buying the collective belief that the price would only ever move in one direction. This minimal capital requirement became the great equalizer, drawing millions of untrained citizens into the market's casino. Hubris was the currency. Discipline was absent. When the market required only a tenth of the capital, the entire system became 10 times more fragile. A small percentage drop in price did not just erode profit, it wiped out the entire initial investment and triggered the broker's inevitable margin call. This forced liquidation. It guaranteed that the selling, once started, would accelerate at a velocity never before witnessed. This simple mathematical equation, designed to democratize wealth, became the detonator. It ensured the inevitability of systemic collapse. Before we continue and get to the main point, I'd like to thank you for the interaction that drives this content. If possible, take a second to subscribe, like the video if you enjoy it, and leave a comment. This helps the video reach more people and guarantees you won't miss the next breakdown. The market mechanizations may evolve, but the human element remains eternally fixed. If you seek the immutable laws of speculation, there is only one true source. We speak of Reminiscences of a Stock Operator, the timeless masterpiece penned by Edwin Lefèvre. This essential text reveals the fatal flaw of taking tips, the necessity of patience, and the profound truth that the speculator must master their own psychology above all else. It is the trader's Bible for a reason. Find the link to this book in the description below. The architecture of speculation was built upon this detonator. It was constructed not out of malice, but out of the human desire for accelerated reward. By 1925, the American economy had entered a state of euphoric self-belief. The Roaring Twenties were defined by a single unwavering conviction. Growth was perpetual. The market was a one-way street leading to universal prosperity. It was no longer a tool for capital formation. It became the nation's primary pastime. The ticker tape was the scoreboard of American success. This atmosphere of guaranteed returns fueled the need for capital that traditional banks could no longer satisfy. Federal Reserve regulations placed constraints on how much banks could lend for speculative purposes. But the demand for leverage was insatiable. A parallel lending system emerged, vast and unregulated, known simply as the call loan market. This was the broker's paradise, the engine room of the boom. The lenders were not commercial banks. They were the great industrial corporations of the era, Standard Oil, Bethlehem Steel, Ford Motor Company. They held immense cash reserves and realized they could earn far higher returns lending money directly to Wall Street brokers than they could through bank deposits or fixed-income securities. Wealthy individuals, too, entered the fray, seeking the elevated interest rates that speculation commanded. This money was instantly liquid. It was callable on demand, 24 hours a day. Hence the name, the call loan. This system funneled billions of dollars directly into the hands of stockbrokers, bypassing the stabilizing influence of the central banking system entirely. The corporations were acting as shadow banks, providing the fuel for a speculative bonfire that they themselves would soon be unable to control. The broker, holding this instantaneous capital, became the central conduit. His job was to provide leverage to the eager public. The mechanism was simple, irresistible, and devastatingly efficient. The prevailing margin requirement often demanded only 10% cash down. A speculator could deposit $1,000 and the broker, using the capital secured via the call loan market, would instantly lend the remaining $9,000. The investor now held $10,000 worth of stock. This was the intoxicating multiplier effect. If the purchased stock rose by a modest 10%, the investor's $10,000 position gained $1,000. That $1,000 gain was a 100% return on the initial cash outlay. The paper profit matched the initial capital deposit. Discipline dissolved. The incentive was to borrow the maximum amount possible. Why earn 6% in a savings account when the market offered a 100% return on capital in a matter of months? The sheer volume of money flooding the call loan system was staggering. In 1926, loans to brokers stood at just over $3 billion. By the summer of 1929, that figure had ballooned to nearly $7 billion. This was capital divorced from productivity, tied only to the expectation of rising stock prices. The system functioned flawlessly as long as the market moved upward. The brokers were happy, collecting commissions and interest. The corporations were happy, earning unprecedented returns on their idle cash. The public was euphoric, watching their small deposits generate immense paper wealth. But the inherent instability of the call loan was its instantaneous nature. When the market faltered, those corporate lenders would inevitably call their money back, demanding immediate repayment. The broker, in turn, would be forced to issue a margin call to the speculator. The moment the music stopped, the mechanism would reverse itself violently. The system was a perfect closed loop of inevitable failure, reliant entirely on one resource that human nature guarantees will eventually vanish: confidence. The market had achieved maximum velocity, built upon debt that could vanish in a single afternoon. The tape was running faster than the economy itself. Hubris had engineered its own fatal flaw. The architecture of the bull market was not built on saved capital, but on borrowed time and borrowed money. This structure, known as buying on margin, was a contract with inevitability. The investor was required to put down only 10% of the stock's purchase price. 90% was covered by the broker, secured by the stock itself. This was the engine of velocity. Every dollar of true capital was instantly multiplied tenfold. During the long ascent, this mechanism delivered staggering, unthinkable returns. It fostered an intoxicating confidence. It allowed the average citizen to participate in a scale of speculation previously reserved for titans. But the mathematics of debt are impartial. They do not care for optimism or historical trend. The vulnerability was absolute. If the value of a $10,000 position was secured by only $1,000 of the investor's equity, the margin was razor thin. The entire buffer of safety, the investor's capital, could be erased by a minor market correction. A drop of barely 11% was sufficient. If the $10,000 asset fell to $8,900, the investor's $1,000 of equity was gone. The investor was underwater. The broker's loan was now inadequately secured. This threshold triggered the margin call. The call was the moment the dream ended. It was a demand for immediate cash collateral to restore the 10% equity requirement. The investor was given hours, not days, to produce funds they likely did not possess. During the years of perpetual growth, the threat of this call was abstract. It was a footnote in the contract, a theoretical risk against a backdrop of endless prosperity. Human nature, driven by the recent past, dismissed the possibility of a systemic decline. Discipline vanished in the face of easy money. But the market does not grant extensions. The true danger was not the individual speculator's ruin. The threat was systemic. The great fear was the collective action of millions of identical contracts. When the margin call could not be met, and for the vast majority of leveraged investors it could not, the broker had only one recourse. They were required by the terms of the loan to liquidate the underlying asset immediately. They were forced to sell. This mandate transformed debt into a deadly deflationary force. Simultaneous massive forced selling flooded the market with supply. The price of the asset was driven sharply lower. The tape, already struggling to keep pace, reflected a panic that was no longer psychological but purely mathematical. The decline triggered yet more margin calls against other leveraged positions, forcing more liquidation, driving prices further down. It was a self-reinforcing mathematical cascade. The system was designed to amplify gains on the way up, but it amplified terror on the way down. Liquidity evaporated. Buyers disappeared into the void. The market had become a destructive feedback loop, guaranteeing that the correction would not be contained. Hubris had constructed a machine of inevitability. The system was now operating without human intention, driven only by the cold arithmetic of collateral and debt. The crash was not an accident. It was the calculated, predetermined consequence of maximum leverage meeting minimum discipline. The vulnerability was not hidden, it was built directly into the foundation. That foundation was 9 parts debt. 90% leverage was the standard expectation. This structure guaranteed fragility. It ensured that the slightest tremor would become an earthquake of liquidation. The system was designed for maximum return, but it was also built for maximum velocity on the way down. Discipline was abandoned for debt. The market waited for the catalyst. It arrived on October 24, 1929, Black Thursday. The selling began immediately. When the market opened, the orders were instantaneous, overwhelming the infrastructure of the New York Stock Exchange. Volume exploded. The ticker tape, the only record of truth, ran hours behind the actual transactions. No one knew the true price of the stocks they held. Fear was the only certainty. By noon, the damage was catastrophic. Trillions in paper wealth simply ceased to exist on the ledgers of the nation's wealthiest speculators. The crisis demanded a response. A consortium of New York's most powerful bankers gathered in desperation. Their plan was simple: impose order. They would use their collective capital to buy key stocks above the current market price, signaling confidence and establishing an artificial floor. Richard Whitney, vice president of the exchange and brother to a powerful J.P. Morgan partner, walked onto the floor. He placed a massive, deliberate bid for U.S. steel. He did not bid at the falling price. He bid significantly higher. The effect was immediate. It was a calculated theatrical gesture of stability. A brief, artificial calm settled over the trading floor. The ticker slowed its panicked pace. For a few hours, the market held its breath, believing the giants of finance had imposed their will. But the bankers' capital was finite. The leverage engine was infinite. Their intervention addressed the symptom, not the cause. The cause was the margin call. The mechanism of the crash was unavoidable. When a stock bought on 90% margin dropped just 10%, the borrower was instantly underwater. The broker who had extended the loan now held insufficient collateral. The broker demanded immediate payment, the margin call. If the customer could not pay, the broker had only one recourse, mandated by the rules of the exchange: immediate liquidation. They had to sell the collateral stock, regardless of the price. This was the mechanism of the forced selling spiral. Every drop in price triggered a wave of forced selling. That forced selling drove the price lower still, triggering the next larger wave of margin calls. It was an exponential downward acceleration engine. The liquidation orders arrived faster than the market could absorb them. The stabilization attempt by the bankers failed because it could not stop the flow of forced liquidation. The underlying structure was too fragile. The brief respite ended Monday. The market realized the bankers' intervention was a temporary facade, a stopgap measure against an inevitable tide. When the market reopened Tuesday, October 29th, the selling was absolute. There was no discipline left, only panic. 16 million shares traded hands, a record that would stand for decades. This was not trading. It was pure, desperate liquidation. The forced selling destroyed the price floor entirely. The wealth evaporated, and the consequences extended far beyond the exchange floor. The massive structure of call loans, the money banks had lent to brokers, secured by the very stocks now being liquidated, suddenly lost its collateral. The security behind billions in bank loans vanished into thin air. The market crash was no longer confined to the speculation class. It became a systemic failure. The tape had spoken. Human nature, fueled by hubris and leverage, had met its inevitable fate. The crisis was now in the hands of the banks themselves. The market never forgets the price of hubris. The immediate aftermath of the crash was not defined by the losses on paper, but by the debt in the ledger. The margin system, the engine of speculation, now became the instrument of personal ruin. Investors had bought on borrowed money. When the collateral vanished into the abyss, the obligation remained. They owed the brokerages. They owed money they did not possess. This was the bitter, final irony of leverage. It promised impossible wealth on the ascent and guaranteed absolute servitude on the descent. The broker, once the celebrated facilitator of fortune, instantly transformed into a relentless debt collector. The power structure shifted violently. Public trust, the unseen foundation of the entire system, shattered. The credibility of the men who drove the tape was irrevocably lost. But the systemic shock went deeper than individual debt. The lifeblood of the speculative market had been the call loan system, money offered overnight to finance margin trades. Confidence was the oxygen of that system. When confidence died, the capital froze solid. The banks, facing staggering losses and the specter of public runs, retreated entirely. Their mandate shifted from generating profit to mere survival. They became fiercely conservative. The instantaneous drying up of the call loan market signaled the end of casual, unregulated risk. Lending ceased. Credit stopped moving. The financial shock transmitted itself directly into the real economy. Commerce stalled. The engine of American capitalism sputtered. The initial governmental response was defined by paralysis. The scale of the collapse overwhelmed the established political order. The belief in market self-correction, a foundational tenet of the era, lay in ruins. The old guard struggled to comprehend the depth of the systemic failure they now faced. Yet the public demand was clear, sharp, and unified: accountability. The era of unchecked power on Wall Street had ended not with a whimper, but with the resounding crash of 1929. The very notion that financial institutions could operate without strict federal supervision was now politically unsustainable. The unregulated environment had proven itself catastrophic, elevating private risk to the level of national instability. The discipline that the market had failed to enforce was now being demanded by the public square. The inevitable shift began. The great, powerful houses of speculation had met their fate. The power would begin to migrate away from the financial district toward the regulatory agencies of Washington. The cycle of unregulated boom and inevitable bust had finally run its course. The migration was absolute. The reckoning demanded a structural response. Franklin Roosevelt's New Deal was built on the ruins of the catastrophe. It was a legislative counterweight to decades of unchecked speculation, a direct attempt to mandate the stability that human nature had refused to provide. The primary target was the ease of leverage. The ability to buy stocks with only 10 cents on the dollar, leaving 90% debt exposed, was the engine of the collapse. This thin sliver of equity guaranteed a swift, destructive liquidation spiral once prices began to fall. The 11% drop was fatal because the average investor had almost no buffer. Congress moved swiftly to construct the guardrails of the modern financial structure. The Securities Exchange Act of 1934 formalized the necessary oversight. This legislation did not seek to eliminate risk, but to demand transparency and enforce accountability. The resulting body was the Securities and Exchange Commission. Its mandate was clear: to supervise the exchange, to police the markets, and to enforce discipline where the pursuit of easy wealth had corrupted behavior. The most profound change arrived in the form of margin control. This was Regulation T. It fundamentally redefined the required equity buffer. No longer could an investor secure 90% leverage, betting the vast majority of borrowed capital. The new standard demanded a significant commitment, often 50% or more. This mandated cushion was designed to slow the velocity of the market's drop. The prices now needed to fall by half before a margin call became mandatory. This eliminated the immediate fatal cliff that had destroyed so many fortunes in 1929. The mechanisms of inevitable destruction had been dismantled. The volatility remained, the cycles persisted, but the institutional leverage was contained. The new rules were not about stopping the market from declining, but about ensuring that the decline could be absorbed without triggering a system-wide collapse. Discipline, enforced by law, replaced the hubris of the unregulated tape. The lesson was codified. The market must have a buffer. The market never forgets its own vulnerabilities. The decade of the 1920s was built upon a precarious mathematical foundation. The fatal flaw was the 10% margin requirement. 10 cents could buy $1 of stock. A dime controlled 100 cents of market risk. This created a profound systemic fragility. When the market began its correction, the required buffer was non-existent. The margin call became the trigger for inevitable liquidation, accelerating the system-wide collapse. This mechanism amplified the deepest vulnerability of human nature, hubris. The investor confused borrowed leverage with genuine capital. They mistook the ability to buy for the enduring capacity to hold. Debt was perceived as wealth. When the downdraft arrived, the borrowed money evaporated instantly. The true capital followed soon after. The speed of the spiral was breathtaking, driven by the mechanical necessity of the 10-cent dollar collapsing into utter insolvency. The entire regulatory structure of the modern financial world is a permanent monument to this collapse. The laws that govern market conduct, the rules of mandated disclosure, the stringent capital requirements, all stand as the enduring warning of 1929. They are the codified acknowledgement of the market's inherent tendency toward excess. Discipline was not born of choice. It was forged in the crucible of necessity. The cycles of boom and bust will continue, driven by the unchanging arithmetic of risk and the unchanging arrogance of the human heart. The tape is silent now, but the lesson echoes across every trading floor. The market never forgets its own vulnerabilities. The market never forgets. The cycles of speculation and panic are eternal. To truly grasp modern financial crises, we must turn to the past. We recommend the classic 2-volume work, 50 Years in Wall Street, by the legendary financier, Henry Clews. Written at the turn of the 20th century, Clews provides a first-hand account of the Great Corners, the infamous gold conspiracy and the panic of 1873. It is a vital, uncompromising study of financial character and market evolution. Find the link to this essential history in the description below.